All right, let's get right into it. If you have ever invested in Thailand, or even are just thinking about it, you need to listen up. The country is tearing up its old investment rulebook. We are talking about the biggest, most profound change to its foreign investment laws in more than 30 years. See, for decades, things ran on a kind of unwritten understanding, a bit of gray flexibility. Foreign investors could get around certain restrictions by using what's called a nominee structure. You know the setup. A foreigner is really running the show, but on paper, a Thai citizen holds the majority of the shares to make it look like a local company. It was a classic wink and a nod deal.
Well, that party is officially over. A new government order has put a hard deadline on the calendar, April 2026. After that date, this entire practice, this gray area, is set to be completely wiped out.
And that brings us to the billion-dollar question, doesn't it? Is Thailand just cleaning house and fixing a broken system? Or is this a massive, high-stakes gamble that could backfire and scare away the very capital it needs to grow? Let's break it down.
Okay, so first up, let's look at what's actually changing. How, exactly, is the government planning to shut down these loopholes that have been wide open for a generation? The absolute core of this whole thing is a shift from form to substance. You see, for years, as long as your paperwork looked right, you were mostly okay. It was a box-ticking exercise. Not anymore. Now, the authorities are digging deep. They want to see real money, a real business, real substance, not just a stack of documents. And this table, wow, it really lays it all out. Just look at the difference. It used to be that scrutiny was minimal. Now, even having less than 50% foreign ownership can trigger a full-blown bank audit. Proof of funds? A simple statement used to do the trick. Now they want to see a traceable cash flow for the last 3 months. But here's the real kicker: partner liability. Your Thai nominee partner used to have very little personal risk. Now, they could face criminal charges. That changes the game completely. Even virtual offices are getting clamped down on. And don't think for a second that these are just new rules with no teeth. The government has a powerful new weapon called iBus. It's a system that connects all the dots, linking the Land Department, the Commerce Ministry, even the Central Investigation Bureau. They can all share data instantly. And get this, in a test run in 2025, they used it to flag nearly 47,000 high-risk companies. The serious cases, they go straight to the Anti-Money Laundering Office for asset seizure. So with all this new enforcement power comes, you guessed it, much, much harsher penalties. And nowhere is this more terrifying for foreign investors than in the real estate market, where the cost of getting caught is about to go through the roof. First things first, a popular myth just got completely busted. You've probably heard of the so-called 90-year lease that developers used to promise foreigners. Well, a Supreme Court ruling in 2025 made it crystal clear. Any lease extension beyond the legal 30-year limit is just a private promise. It is not a real property right that holds up in court. The rug has been pulled out from under that idea. Now this right here, this slide shows the most chilling change of all. Under the old system, if you were caught owning land illegally, you'd have to sell it, sure, but you got to keep the money from the sale. The proposed new rule, outright confiscation. The government takes the land and you get nothing. Zero. Just let that sink in for a moment. 100%. That is the potential loss. A total, complete wipeout of your investment. This isn't a slap on the wrist. It's designed to make using a nominee to own land an absolutely unthinkable risk. And if you thought losing the property was the worst it could get, think again. The government is actively looking to criminalize these nominee structures. If they get listed as an offense under anti-money laundering laws, it would mean the authorities could freeze your assets before you're even convicted in court. So this all sounds pretty drastic, right? Why on earth is Thailand taking such a huge risk? Well, it all boils down to a massive economic gamble. They're willing to scare off all that murky, gray capital in the hope of attracting what they call quality capital. To get why they're so motivated, you have to understand the pressure cooker the Thai economy is in right now. GDP growth is slowing down, household debt is at a staggering 87% of GDP, which means people aren't spending, and public debt is bumping right up against its legal limit. To put it simply, they are desperate for new, healthy, sustainable growth. And here's the official justification, straight from the horse's mouth. The head of the Department of Business Development says these nominee companies distort the economic structure.
He says they rob legitimate Thai businesses of a fair chance to compete. So in their eyes, this is all about leveling the playing field.
And this is their game plan. It's essentially a rebalancing of their entire investment portfolio. They're trying to pivot foreign money away from things like speculative condos and land deals and into these high-tech strategic sectors. Think digital infrastructure, electric vehicles, and green manufacturing. They're trying to trade one kind of investor for another.
But here's where the gamble gets really, really dangerous for investors. We're in what you could call a policy vacuum. Look at this. The old path, the illegal nominee structure, is being aggressively shut down. But the proposed new legal path, things like a 99-year lease, is totally stuck in political gridlock. So investors are caught in this awful limbo where the old road is closed, but the new road hasn't even been built yet. So what on earth does all this mean for the future? If you're an investor, how are you supposed to navigate this incredibly unstable and uncertain new landscape?
Well, the biggest risk on the horizon for 2026 is something analysts are calling policy standstill. There's an election coming up, and that could mean months and months of a caretaker government, delayed budgets, and just paralysis, right at the moment when investors need clarity the most.
So, experts are basically predicting a very turbulent few years ahead, unfolding in 3 stages. First, between now and 2026, expect a panic exit, a fire sale of assets as people scramble to get out of these old nominee structures. That'll be followed by the strategic capital entry, where big institutional investors who can handle the new rules start to come in. And then, from 2028 onward, we enter the high-cost compliance era. Thailand will become a market for serious, professional players only.
So the bottom line is this. The old playbook is dead, gone for good. The great flexibility that defined investing in Thailand for a generation has been replaced by a much stricter, much riskier, and much more expensive game. And that leaves every potential investor with one simple but very tough question. In this high-stakes game, would you bet on the new Thailand?